Hello, everyone, and welcome to this episode of Ignition Time. Could the action from the Federal Reserve, the fact that they're going to be raising interest rates, actually lead to more unemployment? Folks, some news outlets are saying, hey, this is necessary for the economy, but I actually believe this could lead to more unemployment because it could put the brakes on the economy. And the inadvertent effect, the unfortunate effect of the Federal Reserve raising interest rates could be more unemployment. Welcome to this episode of Ignition Time, everyone. My name is Dr. Chhoda. This right here is a little bit of information about me. Check out my video. I have the fortune, the honor, the privilege of living the American dream, and I want to help you live your American dream. So please click subscribe and enable notifications. So here's an article on your screen that was published by CNBC. Inflation is at its highest in 40 years. Here's how raising interest rates could help. But folks, more importantly, I think that raising interest rates could actually backfire on the economy. So what is happening? The Federal Reserve is set to hike interest rates this year for the first time since 2018 to address the worst inflation in 40 years that was spurred by the pandemic. In fact, consumers are already hit with higher prices. They're wondering, hey, how's this going to help? So folks, here's what's happening. According to Tara Sinclair, who's a senior fellow at the Indeed Hiring Lab, this is something really hard for the typical consumer to understand, seeing these fast price raises that are so unfamiliar to large parts of our population who haven't seen inflation rates like this before. And they're trying to figure out the Fed's complicated role in all of this, and it's very confusing. So folks, let me make this simple for you. The Federal Reserve, their main goal is essentially to make sure that the maximum number of people are employed. They want to keep prices stable. They don't want too much inflation. They don't want the cost of things to go up. And they have to control long-term interest rates. Generally, they like to keep inflation at right around 2% a year, which is a benchmark. But now things are actually getting out of hand. In fact, according to Yiming Ma, who's an assistant finance professor at Columbia University Business School, the Fed's main tool it can use to battle inflation is interest rates. It does so by setting the short-term borrowing rate for commercial banks, and then those banks pass it along to consumers and businesses. By the way, these rates affect the interest on credit cards, the interest on mortgages, car loans, pretty much anything you can think of. But what interest rates do is that they slow down the economy. According to Greg McBride, who's a chief financial analyst at Bankrate, the Fed uses interest rate hikes as either a gas pedal or a brake on the economy when needed. With inflation running high, they can raise interest rates and use that to pump the brakes on the economy in an effort to get inflation under control. So basically, what the Federal Reserve tries to do is make borrowing more expensive, and this makes it harder for consumers and businesses to borrow money. It actually reduces demand, and when demand reduces, then supply can keep up, and this brings prices back in check. Now, the Federal Reserve can't do anything to influence or resolve supply chain problems, so this is what McBride said. As long as the supply chain is an issue, we are likely to be contending with outside wage gains. So that's the bottom line, but things can go wrong. The main worry is that if the Federal Reserve raises interest rates too quickly and they kill demand too much, it could slow down the economic recovery, and this is the big problem, businesses could stop hiring or even lay off workers to stay afloat, and this could lead to a higher unemployment rate. This could lead to people losing jobs. In fact, if the Federal Reserve overshoots rate hikes, it could even push the economy back into a recession, and that could halt or reverse the progress that we've made so far. In fact, Sinclair said this: you have to kill parts of the economy to slow things down. It's not a pleasant treatment. So things could actually get worse before improving, and the Federal Reserve has said that they will raise interest rates in March. We don't know what the actual increase will be, but St. Louis Federal President James Bullard said that he thinks the Federal Reserve should push up interest rates quickly. He said this: I do think we need to front load more of our planned removal of accommodation than we would have previously. He said this to CNBC's Steve Leisman. And he also said, we've been surprised to the upside on inflation. This is a lot of inflation. Let's roll the tape and see what Bullard had to say about this. Let's watch.
Yeah, Steve, as you know, we got the hot CPI report last Thursday, I guess, and I think, my interpretation was not so much that report alone, but the last four reports taken in tandem have indicated that inflation is broadening and possibly accelerating in the U.S. economy. So I shaded up my position, and I'm just one person on the committee, but I shaded up my position to say I'd like to see 100 basis points worth of movement on the policy rate by July 1. So I also said I would defer to the chair exactly how to go about that, and he's very good at managing the committee and everything else that goes with this. But I do think we need to front load more of our planned removal of accommodation than we would have previously. We've been surprised to the upside on inflation. This is a lot of inflation in the U.S. economy, 7.5% on the headline CPI. These are numbers that Alan Greenspan never saw. They haven't occurred in 40 years. So our credibility is on the line here. And we do have to react to data. However, I think we can do it in a way that's organized and not disruptive to markets. We're only removing accommodation, so it's still an accommodative policy as we go through these initial rate hikes. They're rather cheap, actually, given that unemployment's down at 4% and the economy is expected to grow, let's say, 3.5% to 4% this year. So I think my position is a good one, and I'll try to convince my colleagues that it's a good one.
In fact, last week, Bullard said in an interview with Bloomberg News that he thinks the Federal Reserve should raise interest rates as much as 1% by July, and other regional bank leaders have expressed a desire to increase rates beginning in March, but Bullard tends to be the most aggressive. They are indeed walking a tightrope, the Federal Reserve, and the goal of the Federal Reserve is to raise rates gradually so the economy slows down just enough to bring down prices without causing too much unemployment. They are indeed walking a tightrope. Let's take a look at another segment featuring the St. Louis Federal President James Bullard, and let's see what he had to say. This is a pretty incredible interview and a pretty incredible set of comments, and this is the direction the Federal Reserve is heading in. Let's roll the tape and see what Bullard had to say.
Some said the January inflation report was really not much worse than expected. Actually, just a couple tenths higher.
No, let me push back. I'm pushing back on that. This is, I said, let's take the four reports together. Let's take the four reports together since October, because it's really October, November, December, January that has really called into question any idea that this inflation was naturally going to moderate in any reasonable time frame without the Fed taking at least some action. So it's that, I think, sure, any particular report is, a few tenths here, a few tenths there, but the big picture is that inflation is much higher than we would have expected, let's say 6 months ago or 9 months ago, and certainly 12 months ago. And so we've been surprised to the upside. And if you look at the Atlanta Fed's inflation tracker, it's all turned red. So it doesn't really matter how you measure inflation. All the different measures are way above their norms.
President Bullard, you're like one of those contestants on Jeopardy who answers the question before the full answer is read. Because what I was going to say was that they didn't expect much improvement in January, and also that the market has already priced in a lot of Fed tightening out there, 100 basis points on the 2-year, and that really going faster or speeding up the rate hikes is not going to bring more tightening into the market or solve the inflation problem before the expectation that it comes down later this year. Is there already a lot of tightening in, and does going faster really make that much of a difference to how much you change the inflation trajectory?
Yeah, Steve, I mean, I love that argument. I have made that argument. I thought I was the one that made that argument. So the 2-year is up substantially since, let's say, last October when this process kind of got started. And that's great. That's helping us a lot. That means that there is some removal of accommodation already in the market, so that's great. But still, the Fed has to follow through and ratify those expectations that have been built into the 2-year. And if we don't, then it makes it appear that we're not defending our 2% inflation target and that we're not trying to put to make sure that inflation is coming under control. I think the inflation that we're seeing is very bad for low and moderate income households. Real wages are declining. People are unhappy. Consumer confidence is declining. This is not a good situation We have to reassure people that we're going to defend our inflation target and we're going to get inflation back to 2%.
So that's where we stand, folks. Let me know what you think. Let me know whether you think the Federal Reserve may end up causing more unemployment. This is a real risk to the US economy. In fact, I believe that inflation and the treatment to inflation, which is raising interest rates, could end up being more damaging to the US economy than the threat of a Russian invasion and higher oil prices. In fact, I think we may be in the middle of a perfect storm, but we'll have to wait and see how things turn out. We have survived the worst of the pandemic. Hopefully, we as a country, with our creativity, with our ingenuity, can maybe get through this as well. Only time will tell. Please click the like button. Please click subscribe. Please enable notifications. Thank you so much for watching. I appreciate you. I'm looking forward to seeing you in the next episode of Ignition Time. Take care. Bye.